No one can perfectly time a recession, but there is one recession indicator which has warned investors of every recession coming for the last 5 decades, and right now this recession indicator is flashing some big red warning signs, but most people are choosing to ignore it. This indicator is called the inverted yield curve, and today this inverted yield curve is showing some of its biggest warning signs that we have seen in more than 4 decades. So the question you probably have is naturally, are we about to enter a recession? But it's not so simple. And let me start by backing up and explaining what is a yield curve. Let's say I wanted to borrow $100 from you, but I only needed to borrow this money for a week, 7 days. You might say, okay, Jaspreet, I know you're creditworthy. I know you're going to pay me back. You only have to pay me 2% interest because it's such a short-term loan. That means you're lending me money for the short term and you're only going to charge me 2% interest. But what if now I come to you and I say, hey, I need to borrow that same $100, but I'm not going to pay you back in a week. I'm going to need the $100 for the next 7 years. Now you might say, okay, Jaspreet, I trust you. You're still creditworthy. But if I have to let go of this $100 for the next 7 years, that means I can't keep making more loans, so I'm going to have to charge you a higher interest rate because I'm not going to have that money back for so long. So now you might charge me 6% interest for that same loan now over 7 years as opposed to 7 days. So now this longer term loan that you're giving me is at a higher interest rate. And this is exactly what a yield curve tells you. Yes, I'm bringing back the whiteboard here, but what it shows you is right here we have time. The further you go out this way, the longer the term of the loan is. And over here we have the yield or the interest rates. And what you'll see on a standard yield curve is that the longer the loan is, the higher the interest rate is because it's a little bit more risk. I mean, even if you go out and get a mortgage, your mortgage rate on a 30-year fixed rate mortgage is generally going to be higher than a 15-year fixed rate mortgage because the bank has to part with their cash for a longer period of time. And so to compensate for that risk, they charge you with a higher interest rate. That's exactly what this is showing you here, and this is what a yield curve is. This brings me to part number 2, which is what's an inverted yield curve. Let's go back to the previous example. When you have an inverted yield curve situation, that means the shorter term loans are paying out higher interest rates than the longer term loans. So if I wanted to borrow that same $100 from you and I wanted to borrow it for a week, now I might be paying you 6% interest to borrow the $100 for a week versus if I borrowed it from you for a 7-year period, now I might only have to pay you 2% interest to borrow it for a longer period. Now you might be wondering, why in the world would somebody ever do that? And the reason why is because people are worried about issues going on in the economy. And now you as the investor might say, well, I'd rather get 2% interest guaranteed for the next 7 years than have to keep dealing with the ups and downs in the market, so that 2% interest over the next 7 years is safer for you as an investor, which is why you're willing to accept a lower interest rate over the longer period than a shorter period. So when you have an inverted yield curve, it looks like this. You can see it's an inversion of this, which is where now the longer the loan, the lower the interest rates that you're paying or that you're getting paid, depending on which side of the equation that you're on. This brings me to the third part of this whole equation that you need to understand, which are treasury yields. Now, if you do want to stay up to date on what's happening in things like the economy and interest rates and the real estate market and the stock market and the crypto market, I created a free newsletter called Market Briefs where my team is breaking down what's happening in the economy. You can read this newsletter in less than 5 minutes every morning, and it's completely free. So if you want to join Market Briefs, it's a free newsletter. You can go to briefs.co/market. That's briefs.co/market, and I also got the link for you down in the description below. In our previous examples, you were lending money to me, Jaspreet Singh, a random guy on YouTube. But instead of lending money to me, you can also lend money to the United States government because the United States government always needs money. They keep spending money that they don't have. This is called the national deficit, which means the government generates dollars through taxes, and then if they spend more money than what they bring in, which they always do, they need to cover this deficit. The way that they cover this deficit is by borrowing money. Now, one of the places that they can borrow this money from is the Federal Reserve Bank, our central bank here in the United States, or they can also borrow this money from regular people and banks and institutions, so you can lend money to the United States government and get paid back with interest. Now, the United States government is known as a risk-free investment, partially because they have the ability to work with the Federal Reserve Bank to print as much money as they want, so they have the ability to pay back their bills. And so if you lend money to the United States government, you have the ability to get paid back interest. This is what a treasury is. Treasuries are loans that you give to the United States government, and the yield or the interest rate that you get is known as the treasury yield. So now if we go back to the charts that I created, this is what a yield curve looks like, which means if you're going to lend money to the United States government for, say, 2 years, that would be a lower interest rate that you'd receive than if you'd lend money to the government for 10 years. The longer time that you're lending money to the government for, the higher interest rate that you'd expect to receive because you're parting with your cash for a longer period of time. This is how it works in a normal world when you have this traditional yield curve. But what we're seeing right now is an inverted yield curve, and more specifically, when investors like to look at the yield curve, they like to look at two different types of treasury yields. They like to take a look at the 10-year treasury yield and the 2-year treasury yield, because you can lend money to the government for a month or 30 years. But the numbers that investors like to take a look at are the 2-year and the 10-year treasury yield. So I'm not going to try to get into all the other complicated stuff. Let's just focus in on the 2-year and 10-year treasury yield. Traditionally, when you have a normal yield curve, the 2-year treasury yield is going to pay you a lower interest rate than the 10-year because, well, the 10-year is a longer period than the 2-year. But when you have an inverted yield curve, that means that the 2-year treasury yield is paying you a higher interest rate than the 10-year treasury yield, which means you would earn a higher interest rate in a shorter period of time than if you invested your money or lent your money to the government for a longer period of time. Now again, this is where you have to understand a little bit of psychology. Why would you be willing to invest your money into a 10-year treasury yield and get a lower interest rate when you can get a higher interest rate with a 2-year treasury yield? And the reason why is because if you're worried about the state of the economy and you just want a guaranteed yield for the next 10 years, instead of having to deal with the volatility of the markets over the next, let's say, 8 or 9 years, well, then you can invest your money into a 10-year treasury yield, get a lower but stable interest rate versus investing your money for the 2-year yield and having to deal with potential market downturns, because if investors are worried about the next few years of the economy, they don't want to have to keep investing your money, and they'll just invest their money for the long term and get a guaranteed return, as opposed to doing more of the short-term investments and getting the higher return, but then having to deal with the market volatility and potential economic downturns. And to understand now the accuracy of these treasury yield inversions, let me read you a line from a CNBC article. The article says, in fact, since 1978, the yield curve has inverted 6 times, not counting the current inversion period, and has preceded a recession each time. So essentially what that's saying is every time we've seen the 2-year and treasury yields invert like this, we have seen a recession come after that. But the question is, how long do you have to wait for a recession? Because if a recession comes 8 years after this yield curve inverts, well, that doesn't really give you a very good indication. So let me read you another line from a CNBC article. Going back to 1978, it takes about 15 months on average for the economy to enter a recession after the yield curve inverts. Now, I want to remind you, this 15-month period from the yield curve inverting and a recession starting is the average. Sometimes it's been longer, sometimes it's been shorter, which brings us to the question of, where are we today? Well, we originally saw the yield curve invert back in March of 2022. Now, the interesting thing about the yield curve inverting back in March of 2022 is you would think that people would say, okay, the yield curve is inverting, there's some red flags in our economy and we should start preparing or start understanding what's going on in the economy, right? Well, that's not exactly what happened. Instead, what you heard a lot of people say is essentially, this time is different. You don't have to worry about the yield curve here. There's nothing to worry about. The economy is strong and everything is just fine. It's going to come back to normal in no time. Now, if you've been doing the math, if it takes on average 15 months for a recession to start after the yield curve inverts, that means if the yield curve originally inverted back in March of 2022, that would mean on average a recession would have to start sometime between September or October of 2023. Again, just an average. And you're not going to know that a recession has started until 6 months after the recession starts, because the technical definition of a recession is 2 quarters, aka 6 months of economic slowdown, and you don't know that you're in the economic slowdown until after it's been declared, which is 6 months after the economic slowdown, but it's again an average. So it takes 15 months on average for an economy to enter quote-unquote recession after a yield curve inverts, but it could also take longer. But this brings us to the question, oh, where are we today? Because after we saw that March inversion of the yield curve back in 2022, we didn't see many red flags. Instead, we saw everybody saying it's nothing to worry about, it's going to go back to normal. Well, it did not go back to normal. Instead, what we saw happen was that the yield curve inverted even more. In fact, we saw the strongest yield curve inversion in the last number of decades happened multiple times in 2023. So no, we did not see the yield curve go back to normal. Instead, we actually saw this steepen even more, meaning you'd see a higher spread between shorter-term treasuries and longer-term treasuries. Now again, the question is, what is the sentiment around this yield curve inversion? Are people paying attention to it, or are they saying it's not that big of a deal? Well, you might not be surprised to hear that people have been blowing it off. Investment News put out an article titled, "Don't Fear the Yield Curve." Bloomberg put out a piece titled, "Is the Yield Curve Still a Liable Recession Signal?" And of course, the Federal Reserve Bank put out their own article saying, "Don't fear the yield curve reprise." Now, if you've studied financial history in any capacity, you know that every time you've seen an economic downturn, leading up to the economic downturn, you had a lot of financial people essentially saying, this time is different. We're not going to see the bubble burst. We're not going to see any downturn in the economy because the economy is so strong, because this time is different. Now, of course, is this time different? Yeah. We have a lot more money floating around in our economy today. We have a lot easier access to debt floating around today. Maybe not the same way as it was before the 2008 crash, but we have a lot more credit card debt. We have a lot more home equity lines of credit being issued. We have a lot more home valuations rising. So it's a different environment, but we still have a lot of money floating around, and we have a lot of debt floating around. And that could contribute to how long it takes to see an economic slowdown. But you can see that investors are naturally worried about the state of the economy based off of how they're investing their money, because you have a lot of investors saying, well, we don't really want to have to deal with this market volatility over the next number of years because we don't know what's going to happen. We think there's going to be some sort of correction in the economy, and because of that, we don't want to have to deal with it. We don't want to put our money into the markets. We don't want to have to deal with the economic downturn. We don't want to have to deal with the volatility. Instead, we're just going to wait it out. We're going to get a slow and steady, consistent return over the longer period and not have to deal with any of that stress. Now, what does this mean for you? Could this yield curve inversion be wrong? Sure. I mean, anything can happen, but you want to understand this because if you look at the current state of our economy, we have interest rates that have gone up very quickly over the last 18 months. The Federal Reserve Bank has raised interest rates by over 5% in 18 months, which is one of the quickest speeds that the Federal Reserve Bank has raised interest rates ever. And this comes after a time where interest rates were at their lowest levels in the history of American modern history. So the Federal Reserve Bank lowered interest rates to the lowest level ever, then they raised interest rates at essentially the fastest speed ever, and now they're trying to cool down demand. They want people to have a difficult time buying a car. They want people to have a difficult time buying a home. They want to increase unemployment. Now, they don't come out and say this directly because that would be politically incorrect. Instead, they say things like, we want to cool demand in the housing market. We want the housing market to return to normal. We want to cool the tightening labor market. What do these things mean? They mean they want less people to be able to afford a home. They want less people to go out and have a job, because if people have less money or less access to money, they'll have less ability to spend in the economy. And if people have less ability to spend in the economy, that cools demand down, and that will help reduce the prices of things growing, because inflation is still around. Inflation is still growing. And because of that, the Federal Reserve Bank is working to increase interest rates to cool down inflation. And the way that they cool down inflation is cooling down spending. And the way that the Federal Reserve Bank cools down spending is by making things more expensive. Now, they can't go to Walmart and say, hey, Walmart, raise the prices of your stuff. Instead, what they do is they raise the prices of debt. They raise the borrowing costs of money, because the Federal Reserve Bank has the ability to control interest rates. Now, the interest rates that the Federal Reserve Bank controls is not the interest rate that you pay on your mortgage. It's not the interest rate that the government pays back, although the Federal Reserve Bank interest rates really do influence the short-term debts. The Federal Reserve Bank influences the interest rates that banks have to pay one another to borrow money in the short term. So it changes the wholesale cost to borrow money. So as the Federal Reserve Bank raises interest rates, borrowing costs across the board, whether it's for treasuries, whether it's for a mortgage, whether it's for a car, whether it's for a business loan, all these interest rates start to go up, which makes it more expensive to have or get more debt. And that then reduces demand, which then cools down spending, which then cools down the economy, which then you can see how that would affect the entire economic system. So what does this mean? Well, we have this inverted yield curve happening right now. It has seen, or has gone to, the most steep inversion that we have seen in many decades, which means this is something you want to pay attention to. You have a lot of people saying, oh, don't worry about it, this doesn't matter anymore. But This is where it is your job not to just blindly trust anybody, including the Federal Reserve Bank, even though they're saying on their website to just ignore this yield curve inversion. What this means for you is it is your job to be financially educated, and it's your job to understand what's happening. That way you can, number one, understand, but also capitalize on potential opportunities that come your way. Because if we do see an economic slowdown, well, that means you could also find some great investment opportunities, because recessions create more millionaires than any other time. However, it requires you to be patient. Because, well, if on average it takes 15 months after a yield curve inverts to see a recession, that means it could take longer. And today we have a lot of money in the economy. And it's not just people having cash in their bank account. It's people having the ability to spend. People have the ability to spend more money on their credit card. Why? Because as incomes have gone up post-pandemic, credit card levels have gone up in the sense that people can now have more credit lines. Plus, home levels have gone up, which means people have more equity in their homes, which means people can pull more cash out of their homes. These are both very, very, very bad things to do as a consumer. I do not recommend you do either of these things, but it means people still have the ability to spend. And as long as people have the ability to spend, the economy can keep on chugging. And this is where you have investors saying, well, we see the red flags in the economy and we don't want to deal with this. And this is where it's your job not to just stay away from the markets, but to understand the markets. That way you can capitalize on opportunities that might come your way. Who knows when we were going to see the actual economic pain? Who knows what's going to happen in the future? But it doesn't cost you anything to be prepared, because yes, there are red flags out there. So what can you do? Well, what I say is 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart. This is the time now to, number one, be building your financial education, and number two, be working to prepare yourself, meaning put some cash aside to protect you, because in case something happened to your income, well, you have some cash to fall back on, and in case we do see an economic downturn, you have cash now to capitalize on investment opportunities that might come your way. So just understand what's happening and not panic, but understand what's happening. That way you can be prepared for anything.
Your 20s are a time when you first start making money, and it's very common and normal to be dumb with your money because, well, it's the first time you ever make money. So now you want to go out and buy the nice things. You want to start spending money. You want to start going on vacation. You want to start buying a nice apartment. You want to get a nice car, and you want to just start exploring and enjoying life because you're finally out of school and you're finally making some money.